More now on this morning's interest rate hike by the European Central Bank, the first in almost 3 years. My next guest says this, though, could be lights out for the European periphery and a danger for the Eurozone itself. For more, we're joined by Michael Darda, the chief economist and chief market strategist at MKM Partners. Mike, it's been a while. Good to see you again. What do you mean by lights out?
Good to see you. Thanks for having me. So essentially, Betty, what this means is that with the ECB tightening monetary policy, they're essentially going to force the periphery to contract and deflate. That's how these adjustments will go forward. In order to restrain inflation, say, in Germany and France, the periphery is going to be pushed into a deflationary situation. Fiscal austerity will fail if that's the backdrop. So unfortunately, I don't think the outlook is incredibly bright for the Eurozone. We've argued that despite the mirage of low central bank interest rates, just 1% and now 1.25%, really monetary policy doesn't look very loose if you look at the monetary and credit aggregates. So the ECB's balance sheet, which they have direct control over, is actually contracting at almost a 3% annual rate year over year. For the first time since February 2010, right before the first round of stress in those debt markets.
Okay.
The broader aggregates are also very weak. So I think we already had a tight money situation in Europe. Coming into this hike, this is going to make it worse, not better. In
other words, Trichet is barking up the wrong tree.
He sure is. If the European Central Bank is not going to provide the backdrop of reasonable nominal GDP growth for the Eurozone, then there really is no way out for the periphery. Now, the argument against what I'm saying is that, well, hey, look, Germany's booming. They'll end up with a bubble, something on that order. But if you look at the Eurozone as a whole, total Eurozone nominal GDP growth in the fourth quarter slowed to a 1.2% annualized rate. That means the ECB benchmark interest rate with today's hike is above that. That's not easy money. That's a prescription for a recession. So even with the strength of Germany, it's simply not going to be enough with the periphery flat on its back with these liquidity measures as tight as they are in Europe.
But does the periphery matter in the sense for the rest of the Eurozone if Europe is able to keep that firewall up around Ireland, Portugal, Greece? If they're able to keep that firewall up, then does it really matter?
Well, I think about it this way. If these problems end up bleeding into Spain and Italy, that's going to be a much bigger problem for the Eurozone itself. And at some point, if Germany and France are compromised, then you run out of people to get bailouts, or strong countries to get bailouts from. So Spain and Italy together are 4.5 to 5 times the size of the other troubled countries, the so-called pig countries, Ireland, Greece, and Portugal. They are not out of the woods. The debt markets have relaxed a little bit in recent weeks there, but the reality is Italy is still in recession. Rate hikes are not going to help. Spain is racked by 20% unemployment. Higher funding costs certainly are not going to help there. And what's interesting here, or shocking, is that yes, the ECB is an inflation-targeting central bank. Inflation's above the target, so they're raising rates in a mechanical way. They did the same thing in July 2008, and it was a disaster. Yep. But they're also supposed to focus on a reference rate for broad money. Broad money is growing at only less than 0.5% of their reference rate. So there's really no reason the ECB has to go through with rate hikes.
Right. So Michael, essentially then, this whole strength we've seen in the euro is a head fake. You're going to see the euro go down.
I think the strength of the euro means that money's tight in Europe, and if it has to be eased at some point because the ECB is blowing it, and I think they are, then the euro will fall.
Michael, thank you. Michael Darda of MKM Partners, the chief economist and chief market strategist.